What is long and short in crypto trading? In crypto trading, long and short refer to two different trading strategies. When a trader takes a long position, they are essentially buying a cryptocurrency with the expectation that its value will increase over time. Traders hold onto their positions for an extended period, ranging from days to months or even years. Long trading is suited for traders who are optimistic about the long-term potential of a crypto asset. It is a crypto trading strategy commonly used when the overall market sentiment is positive and prices are rising, which we call a bullish market. For example, a trader might buy Bitcoin and hold on to it for a couple of months, anticipating that the price will go up in 3 months' time. On the other hand, short trading, also known as shorting, takes a negative position in the market. Traders who go short anticipate that the value of a crypto asset will decrease. Short positions are typically held for shorter durations, often ranging from days to weeks. Traders profit from falling prices by borrowing the crypto from a third party, usually a broker or exchange, and immediately selling it on the market with the expectation that its value will decrease. For example, after doing some analysis, a trader predicts the price of Bitcoin will drop over the next week. As predicted, the price of Bitcoin falls and the trader immediately buys it back at the lower price, returning the original Bitcoin to the broker and pocketing the profit from the price difference. These strategies are used by traders to profit from both upward and downward movements in the price of cryptocurrencies. It's worth noting that short selling is riskier than buying long because the potential losses in a short position can be theoretically unlimited if the price of the cryptocurrency rises significantly.